And the crisis in the Eurozone has pushed the Brent crude prices below $98 per barrel today. Investors are now keenly watching out for the Greek elections on Sunday. This vote is seen as Greece's verdict on its future in the single currency bloc. Meanwhile, the OPEC has said that the global oil supply and demand balance could ease further in the second half of the year, saying that the demand for its oil could average 30.74 million per barrels on a daily basis in second half of this year. Currently, the Brent crude prices on your screens, we've seen more than 0.5% decline coming in for that one, while the NYMEX is holding $82 per barrel. For an expert view on crude prices, let's go across to Gordon Kwan. He's head energy research at Mirae Asset Securities, and he joins us in Hong Kong. Gordon, hi, welcome to the show. Let's start with the China first, and the crude imports for the month of May have been at record highs. Do you see that as any number changer for the crude prices?
I think this signals to the world that despite all the doom and gloom talks that China is slowing down, China's economy is not collapsing. China's May import crude number is an all-time high, is up 12% versus the April number. So China is still demanding a lot of oil, whether it's for commercial purposes or for strategic stockpiling reasons. There is still good demand for crude oil at lower prices from China.
Gordon, while much of the geopolitical premium is off the crude prices, the latest reports show that the UN and Iran have yet to reach a deal on the nuclear program probe. Do you see that yet as a big issue?
Definitely, and that's why in the medium term we are optimistic for oil prices to rebound, because I think futures will regain the lost geopolitical premium once we get into winter, especially when the central banks have started implemented some more stimulus measures. So the attention will reshift from the EU debt crisis back to the geopolitical front in Iran, maybe in the winter time.
Gordon, much of the concerns are coming in from the Eurozone. They have agreed to lend Spain up to nearly 100 billion euros. Do you see any picture changing because of that for commodities, especially crude?
We see it more as just a band-aid for the EU crisis, because I could imagine that Italy will need the same sort of rescue, and that's what the market is worrying. So despite the Spain bailout, we still see potential weakness in the short term for oil prices, even though it is extremely oversold. So we are not too excited about this 100 billion bailout of Spain at the moment.
All right, Gordon. And just before we let you go, what's your sense on the NYMEX and the Brent crude prices for the near term and by end of 2012?
In the near term, technically speaking, if Brent fails to hold 95, we could see $90 very quickly. And for the WTI, it would still be at a $20 discount to the Brent because of all the overwhelming shale gas and shale oil production in central USA. So in the short term, if WTI fails to hold $80, we could see 75, in which I expect to see extremely solid support.